Mary Louise, I've got a hot topic. Can't get away from it. It's everywhere. It's on the news. Inflation, interest rates. You must be absolutely sick of this question.
Absolutely.
What I actually want to know is inflation. They talk about inflation like we all know what it is, but like what actually is inflation and how does it affect borrowing, loans?
So, a simplified version, inflation is the cost of goods and services increasing. So things like groceries, fuel, electricity.
Lettuce.
$12 lettuce. So yeah, inflation then has you could say a domino effect on our interest rates. Right. So you'll know the Reserve Bank or the RBA meet every month. Now, the only tool they have in their box to help bring spending down is to adjust interest rates.
Right.
So on average, most Australians' biggest financial commitment is their mortgage. Mm-hmm. The fastest way to help curb spending is to increase rates so that there's less disposable income every month.
So they want us to stop spending our money? Is that the idea behind it?
Yeah, so the higher the inflation goes, typically the higher interest rates also go.
Okay, so they kind of marry each other, right?
Like I said, it's a domino effect. So when one is high, they need to adjust the other accordingly to bring, expenses and economy back in where they want it to be.
So when we're going for a loan and we're seeing it all the time now in the headlines, interest rates are increasing. How does that affect like how much I can borrow?
Yep.
And like how often does it sort of change?
So when we talk about borrowing capacity or servicing a loan, what we're looking at is income, commitments and expenses, and what is left and available to repay a home loan.
Okay.
So when we do your borrowing capacity, we are looking at the interest rate the bank will offer you. There is also a buffer added to this rate to ensure that, if the interest rates kept rising, your standard of living isn't compromised. So we call this an assessment rate.
Okay, so it's two different things.
Two different things. So when we're looking at interest rates and assessment rates, the higher our interest rates get, the higher our assessment rate gets. That means you can borrow, like what you can borrow is decreased.
Right.
So it is, like I said, it's a domino.
Right, so if I came and seen you 3 months ago and you said to me that I could borrow $500,000 for my first property.
Yep.
And then I come to see you today, then that amount would drastically...
It may, depending on the interest rates and there's lots of factors that can influence what rate the bank will offer.
Okay.
But in a simplified version, yes, you may have come to me 3 months ago and it was at $500,000. Now, because of the interest rate rises we've experienced, it may drop to $450,000.
Okay. And then if I come to see you today and I get pre-approval for $500,000, how long does that pre-approval last?
So the great part about a pre-approval, you've got 90 days from that pre-approval date to find a property and sign a contract. So for that next 90 days, you don't have to worry too much about assessments. It's more find that property, sign that contract.
And am I locked in at that rate when I first seen you?
There's two types of loan families, Melinda. We've got our variable family and we've got our fixed rate family. So for people that are really, really conscious of rates or they're budgeting and they want to know what their repayment is, a fixed rate loan can often be a great solution as it offers certainty of repayment.
Okay.
With a fixed rate loan, you do have to pay to keep it locked in, to ensure you have the same rate at the time of submission.
I guess that gives you a bit of security though, right? So I've come to see you, I know I'm going to be able to afford this payment at this price.
Correct.
I lock it in, I pay a fee to lock it in, and that makes it valid for 90 days?
That's correct,
oh,
yes.
Right.
So it's what we're referring to is called a rate lock fee or a rate guarantee fee. It's really, really popular at the moment. Everyone, you want to know what your repayment's going to be. So it's a great option that the lenders offer to ensure that, you know what your interest rate will be come settlement.
I guess it comes back to like broker versus bank. There's so many options out there.
This is right. Absolutely.
I had no idea that there was so many different things that we could do.
And that's where having a specialist and having an advisor that you trust and you have that relationship with, that's the difference.
Yeah, right.
That is the absolute difference.
That's awesome. Thank you. I really appreciate that. Hope that sort of clears that up for everyone too. Thank you.
Thanks.